Hello and welcome to the Trading Bell. I'm Nokip Kimbo, and today we are talking about the markets. I know the year is pretty young. You want to know what exactly is going to be happening in 2023. We do not claim to be prophets, but based on what happened in the year 2022, we can at least project on what 2023 portends. I'll be having a chat with Gregory Waweru, the Chief Executive of SBG Securities. Welcome to the show, Gregory.
Thank you. It's a pleasure.
Yeah. So, looking at the Kenyan market, we're just starting the year 2023, but 2022 is that year that had so many lessons. For starters, it was poised as the year of recovery, because the impact of COVID in 2020 sustained in 2021. 2022 was sort of the bounce back year. Then we also had another factor. An election came in play. Then we had the Russia-Ukraine situation. So many headwinds. By the time we were closing the year 2022, looking at the markets from where you sit, what were the greatest lessons that we could pick from that particular year as wavy as it was?
Yes, thanks. No, I think it was a tumultuous year in all aspects. I think what we can draw from it is that global shocks have significant impact on our markets beyond what we may be perceived, we may perceive as beyond what we may perceive beyond the local events. For example, the elections that you did mention. As a consequence, I think it's very important to put into context the influence of global events into our local markets. You did see, for instance, last year, there was quite a lot going on, and this goes beyond the Kenyan market. A lot of markets closed in the red. It was very clear inflation was a very dominant theme through 2022, which led developed economies to raise their benchmark rates, which again triggered the capital flight that has eroded a lot of the gains that we've had in prior years. So I think in a nutshell, the situation is such that global events have a very dominant impact on our markets today, and I think that's the current construct, which maybe we need to also look at in terms of how the composition of markets in terms of trading activity between local and foreign does play out in the markets.
Definitely. I'm glad you've brought that issue in terms of composition, which has been a huge issue right here at the NSE. Local players vis-a-vis, foreign investors. And we see this during election years, the holdback, the pullout, and now with, the rates being hiked at an ever-increasing rate in the States, even more pullout in some of these, upcoming markets, nascent markets. Locally, how can we build that local investment curve to be able to see sort of stability amidst global turmoil, at least to have your own within your market?
Thanks for that. It's an interesting question because I have long held the view that the domestic investor base gives you an anchor in challenging times, and I think that is very clear from the evidence that we observed from 2022 in terms of market activity and the interplay between foreign and domestic investors. I think you'll appreciate that. We've had foreign investors dominating, for instance, average daily trading volume activity at the NSE, and as a consequence, that has had an impact in how, for example, price discovery takes off, or vice versa. And I think that is really the crux of it. In sub-Saharan Africa, typically we've seen much lower domestic investor participation compared to, for example, some of the North African countries like Morocco and Egypt, where the domestic participation is much higher than even in some cases higher than foreign. And I think that is really the important point. Again, in situations where global shocks are being experienced, the foreign investors will naturally look back to their own markets when there is a risk-free sentiment across the board, and I think that is that's the reality we face today.
Mm-hmm. And I mean, looking at majority of our counties here at the NSC, we don't have so much fluctuations. So in terms of capital gains, making money from trading stocks is a little bit limited. Majority of people, wait on dividends, look at dividend shares. But also that was hard hit during post-pandemic era, the year 2022. Almost half of the counties, they didn't issue a dividend. In terms of the strategy to approach investment in equities out there in this year, is it something that we need to have a different approach? Is there a better approach to it?
I think it's an important question, and that leads me to think that investors need to be a lot more selective when picking assets, and I think this is very clear because there are those that seek dividend returns, in which case they will have the propensity to invest in high dividend yield stocks. There are those who seek capital gains. And remember, we are largely a long-only market, meaning investors only benefit when share prices actually rise. We don't have a shorting really taking place at the moment. So I think the lesson is that investors need to look at their own circumstances and figure out where the benefit is. And clearly the dividend stocks tend to have quite a bit of an attraction, and they tend to be, the high dividend stocks tend to have some defensive qualities which investors do like, particularly because that provides a cushion when the markets are not particularly performing well.
Yeah, definitely. So you talked about sort of having more local participation. And this has been a talk even from the top office in this country, sort of democratizing participation in the stock market. The president famously put it, tunataka mama mboga akuwe pia amenunua shares, to be able to reach at that particular level. I know technology is one of the avenues that has been poised as a vehicle for this particular change. Do you think that can accelerate, and what do we expect in that field in the year 2023?
Certainly, technology can accelerate it. We can have a tech-led strategy, but I think the other important element is actually to educate and to support the investing public, to broaden it in all aspects. I think you need to democratize, at every level. Now, the bigger question is, do we have an ingrained savings culture, or an investment culture outside the traditional asset classes such as property? Because I think that is where people do invest, but the question we are asking today is what can be done to crowd in these investors into the capital markets, and I suppose that's a $1 million question. So I think it will take a combination of successful strategies that will address both the demand side from the investor standpoint and the supply side from an issuer standpoint. I think we need to continue having high quality issuers in the market, of which we do, and even for the future, for bringing new IPOs and listings to the capital markets. But at the same time, we must figure out how to crowd in these investors and making it easy for them to invest, making it as easy as possible through technology, through education, and how to support them make investment decisions, and more importantly, change the investment construct, not to be only real estate, people looking at plots of land, but also looking at other ways of enhancing their portfolios. I think that is really the solution, and to think about to encourage investors to not so much think only about allocating assets, but also allocating risk across the various asset classes.
And looking at investment as a phenomena, because sometimes we talk about democratizing and making it so easy to participate in the stocks, for example. somebody says,
Yeah.
the cost of living, inflation,
Yeah.
all this is eroding into what I would have put there. So in terms, even on a macro level, as a country, is there things that we need, some bolts that we need to tighten to make sure that the after effect is that people are gaining more interest on top of, better education and information and, knowing and technology also being used? Are there some of these macro elements that we need to tighten to make sure that at least we are having a more vibrant market?
Certainly, the propensity for investors to save and invest is also driven by the level of household incomes. And I think in today's world where inflation is a concern, that does have an impact on people's discretionary incomes. Some of them are still eroded post-COVID, and I think the repair is still somehow taking place in certain aspects across certain sectors. But the important thing is to say that it has to be seen as a journey. And what do you need to do to stimulate savings? What do you need to do to stimulate investments at domestic household levels to crowd in investors, individual investors meaningfully? I think that is really the question. So solving the macro fiscal challenges of today and navigating them successfully in a way that stimulates growth of incomes is quite crucial. Therefore, to ensure that in the long run, investors will continuously look to invest in the capital markets.